Good morning, everyone, and thank you for joining us. I know all of you are busy, and I also know there's no shortage of reports when it comes to APAC, PE, private equity, and venture capital scene. So let me start with why we think this report is worth your time. Most private capital reports begin with the same question: where is the opportunity? That still matters. But in Asia today, it is not enough. The harder question is, where can this opportunity actually be converted into realized returns? That's the central idea behind the Vistra friction index, turning friction into capital flow, which we are launching today in partnership with Vistra Fund Solutions. At DealStreetAsia, we cover Asia's private capital markets every day: fundraisers, deals, exits, LP commitments, secondaries, private credit, the VC space, private wealth, and capital flows across the region. And one thing that we are hearing from both GPs and LPs all the time is this: Asia remains compelling, but it has become but it's become much harder to underwrite as one broad regional story. India and China are not similar. Singapore and Indonesia are very, very different markets. Hong Kong and Vietnam, again, extremely different markets. Japan is very hot, but it's very different from India and Southeast Asia. And even within Southeast Asia, the private equity story and the venture capital story is starting to look very, very different. And it's also different for different countries. That is what this report tries to do. It tries to do something like very practical. It does not simply rank growth. It looks at two things together: opportunity and friction. So, where do fund managers see growth? Where do they see value creation? And how do they see risk adjusted returns? And where do they see the real barriers? Is it governance, risk, regulatory complexity, weak exit liquidity, the currency, the FX volatility, LP concentration, fundraising pressure, and the cost of running multi market strategies? The report is based on proprietary survey, and we spoke to over 105 fund managers across APAC, from both the PE space and the VC space. And that's very important because when it comes to PE and VC perspectives, and that distinction matters because for both asset classes are now reading differently for different parts of Asia and also for different countries. Maybe I'll just take a minute to highlight a few findings from this report. First, the APAC private capital has clearly moved from abundance to selectivity. There is a flight to quality. This is not a retreat from Asia. Capital still wants exposure to this region. But the broad growth narrative no longer works by itself. GPs and LPs are asking the hard questions around entry discipline, governance, FX, exits, and DPI. Second, India stands out as the clearest conviction market in the report. More details will be shared as we present the report. But even India is not friction free. There are issues of regulation, competition, valuations, and operational complexity that still matter. Third, Southeast Asia is more nuanced and more broad than the headlines suggest. And the report shows that Southeast Asia screens more favorably through a private equity lens when compared to the VC lens. PE managers appear more constructive on markets such as Vietnam, Malaysia, Philippines, Indonesia, and Thailand, where formalization, consolidation, and operational improvement can support returns. But VC fund managers who took the survey are far more cautious. They're cautious on exits. They're worried on follow-on capital and the ecosystem depth. The fourth point I wanted to highlight is capital formation has become the dominant, pressure point. Most managers we surveyed cited fundraising as the main source of friction, even ahead of exits and deployment. And that tells us something very important. The problem in Asia today is not simply whether there are enough companies to invest in. It is whether managers can raise, retain, and recycle capital through successive fund cycles. And finally, the fifth point: exits and fundraising are now part of the same story. When exits slow, DPA becomes harder. When DPA becomes harder, LP re-ups weaken. And when LP re-ups weaken, fundraising becomes a lot more fragile. That is a capital recycling problem this report is trying to make more visible. And for media, I think there are several stories in this report. I'll let our research head Andy and our panelists share. But there is a story on India. There is a story on Southeast Asia, how the PE and VC readings are diverging. Then there's a Hong Kong and Singapore story, and these countries or these geographies matter to as institutional structuring and exit platforms, even when domestic growth is not the main thesis. And then there is Indonesia, the other countries, right? Vietnam, Malaysia, Philippines story, where investable opportunity exists, but exits, governance, ecosystem maturity, and capital market depth, are still major issues that impact the confidence. And there's also a broader LP story, why Asia allocation is no longer about a single regional thesis, but it goes from market to market, strategy by strategy, and from manager to manager. So, in the next few minutes, my colleague Andy Haswidi, who's the head of research for DealStreetAsia, he will walk you through the key findings and what and his team has done a tremendous work on the report in close collaboration with Vistra. And I'm also pleased to announce or to introduce the fellow panelists. We have David Anderson. He's Executive Vice President APAC at Vistra Fund Solutions. So Vistra brings the practical on-the-ground view of how fund managers navigate formation, structuring, compliance, governance, reporting, and execution across different jurisdictions. Then we're also joined by James Tan. I'm sure many of the media would know him quite well. He's the managing partner at Quest Ventures. And we would love to hear his take on the VC side, especially across Southeast Asia, where the opportunity remains real, but the path to liquidity is often a lot longer and narrower. And finally, we're very grateful to have Johan Rosali, who's the founder and CEO at Bintang Capital Partners. He joins us from KL. Now, he brings a PE perspective, especially the mid-market perspective, and also the Malaysia perspective. And again, he can talk about the impact on, he can talk about impact, governance, value creation, and practical challenge of covering growth, converting growth into realized returns. So our hope is not just to, like today, what we want to do is not just present another report, but we want to give you a sharper way to think about the Asian private capital at this point in the circle. So the question is, where can growth be underwritten, governed, exited, and returned to investors? And that is something that this report will seek to address. And I will let our panelists take it forward from there. David, over to you. Let's start with you.
Excellent. Thank you, Joji, for the introduction, and thanks everyone for joining us today. As mentioned, very happy to have this year's PE/VC Friction Index out, and really look forward to getting it into the market. As Joji mentioned, we focused really on building out this report to review the opportunities and also the challenges with operating in the different markets of APAC. We looked at the region market by market for the opportunities that investors see across different pillars, which I'll come back to. And we compared those with the friction and the challenges associated with doing business and executing deals and ultimately generating return in 15 APAC markets in which we focused. So the report really does provide an interesting view on the geopolitical, macro volatility, tighter liquidity conditions, and uncertainty around exit optionality, and ultimately how that plays into the consideration around where and how GPs want to spend their time. So we saw pressure points really at each end of the investment cycle, and I think this was just touched on, but really on one end from the fundraising side, 57% of respondents cited that as kind of fundraising the number one pressure point, all the way through the cycle to exit, which ranks second at 26%. Obviously, driving some of the fundraising challenges, the LP re-up rate was surprisingly, well, I found it somewhat low. Over 40% of managers reported fewer than 40% of existing LPs reinvesting in the next fund. So the report really does focus on kind of touching on the reason for some of those challenges. And then having said that, I mean, those are the challenges. Obviously in APAC, it's a very, very diverse, very broad region and plenty of opportunities that this report outlines as well, right? And ultimately how are GPs assessing the region. We still see governance, ecosystem maturity, a really sharp kind of dividing lines across different jurisdictions and countries. And also operational maturity is just as important as deal sourcing to generate returns and ultimately allow our GPs to retain the institutional capital. If you can go to the next slide. Sorry, I didn't realize the slides were up. Delayed. Um, Next one. Yeah. Yeah. So this was covered. Fundraising pressure point, the number one pressure point in the other end of the kind of capital recycling is the exit challenges. I mentioned the re-up rates are quite a bit weaker than at least I would have expected. And then this goes through kind of the diagnostic tool to really provide a practical guide for turning opportunity into returns. On the next slide, a quick kind of just outline of Vistra. I think Joji kind of covered DealStreetAsia. On Vistra's side, look, we've been very happy to partner with DealStreetAsia to develop this report. Vistra Fund Solutions, as a quick background, we administer over $1 trillion AUA for our clients. We work with 40% of the top 50 PE funds globally, multi-regional funds as well as domestic and mid-market funds across both PE, VC. We have 2,000 specialists across 50 different jurisdictions globally. And ultimately, all the main markets that we covered in this report, we've got boots on the ground and specialists on the ground to support our clients. So the key focus for this report is ultimately kind of where does the opportunity intersect with friction in operating in different jurisdictions, and that's core to kind of how Vistra focuses our time and energy, right? Really removing friction, reducing friction for GPLP clients throughout the investment cycle, from fund formation, capital raising, all the way through portfolio management, reporting, and exit. DealStreetAsia, obviously, leading APAC private equity, private capital intelligence platform, and a great partner on this story. On the next slide, gives a bit of a lens into, I don't want to steal any thunder, but what we did is from a very high level, we engaged over 105 PE VC fund managers. Those are founders, managing partners, managing directors, investment directors, et cetera, and focused on 15 different APAC markets. In building a dual axis evaluation framework, it really allowed us to look at these 15 markets and compare the investment opportunity across growth potential, operating environment, value creation, and risk-adjusted return, with plotting against the friction index, or where friction exists in the markets, the 15 APAC markets, across governance, regulatory complexity, ecosystem maturity, exit liquidity, and macro and FX risk. So it is a great read. On the next slide, a quick view of kind of the number of regional SMEs from both Vistra Fund Solutions and DealStreetAsia who are involved, as well as a number of GPs from EQT, Tata Capital, Quest Ventures. James, thanks for joining us today. Leaf Green Capital, Synexia Ventures, and thanks to all the folks who really helped pull this together. It is a great report and a great read. So very briefly, on the last slide that I have, what you'd expect to find is really a detailed market-by-market scoring table across all the dimensions of this report, right? A focus on capital formation, crisis analysis, and then again, as Joji touched on, kind of the difference between how PE focuses and how VC focuses, and the divergence in insight, which maybe isn't surprising, but it's really interesting to see how the different GPs focus or prefer to focus their time and energy. And finally, there's a good practical kind of guide for navigating APAC markets. So really looking forward to getting this out. And again, thanks to everyone who was involved in putting it together. I'll stop there and pass it back to you, Joji.
Yeah, thank you, David. Just maybe a quick question to you, before Andy presents the findings. The report's, central thesis, and I mentioned this earlier too, that allocating to APAC as a single thesis is over. So fund managers have historically taken a broad regional approach. What does this actually mean in practice, and where do you see the biggest gap between market perception and on the ground reality?
Yeah. Yeah, look, I think it does a good I think the report does a good job highlighting kind of the generalist investment approach for APAC just isn't going to work anymore. Markets are far more competitive, sectors are more competitive with specialization. And I think what this report does is across these 15 markets really maps the efficiency opportunity that India, Japan, South Korea, Singapore, Australia provide, and kind of compares that to what we're calling the precision entry approach for Indonesia, Philippines, Thailand, and Cambodia that's really required. In looking at India, the friction, there is quite a bit of friction, but it's underwritten, right? It's not absent. And so it does exist. The opportunity index for India top the charts at 7.78. But then really on that friction side, governance was 52, regulatory, I think was like 54, and FX is a challenge with the rupee at 71, right? So those friction levels are above the APAC average. But again, given the opportunity, that risk is underwritten. China, I think, was a bit of a contradiction, right? It scores the highest on the adjusted returns at 75, but it carries elevated kind of friction as it relates to governance at 57 and regulatory friction as well. But again, investors are pricing that in um, to kind of compensate for the potential risk there. And then the other thing I'd say is it was really interesting to see kind of the divergence in PE and VC, right? PE very much focused on Southeast Asia as more actionable as a market or region, and VC maybe higher conviction or concentration for North Asia.
Got it. David, one last quick final question. The report actually shows operational friction, multi jurisdiction structuring, LP reporting, KYC, AML now scores higher than fundraising friction itself. And, in your introduction, you said you administer over $1 trillion of AUA across 50 jurisdictions. So where do you see the sharpest demand from GPs looking to turn that operational complexity into a competitive edge rather than drag on returns?
Yeah. Yeah. I mean, maybe not surprisingly, right? It seems that regulation and other regional aspects, as it relates to the areas here that we've studied on the friction side, the region could be diverging versus converging, right? And you can see that in the CFO friction dashboard, right? The operational friction scores, I think, say in the 50s, right? And that exceeds the capital formation friction that's in the 30s, right? Or 30 to 40. So said differently, the back office is potentially generating more drag than the fundraising mechanics on the front end. And so that's one aspect where I think, again, obviously ties to Vistra's solutions that we offer clients. But the other piece is the complexity around operating across multiple jurisdictions, right? The report touches on kind of Singapore as a hub for the region to jump off, and Hong Kong is kind of still an entry point to mainland China, and potentially other parts of the region. But that multi-jurisdictional structuring piece scores a 59, which is the highest in the CFO friction dashboard. And so that's pretty big. And you compare that to the fundraising challenge, it's 57. So operational complexity is definitely underpinning. Um, it would seem to be the real structural issue. And ultimately, look, I mean, it's I suppose a good kind of view from the Vistra perspective, because again, like I mentioned off the top, right, our main focus is really removing or reducing friction for our clients so that they can focus on what they do best, and we can manage the operational side of it from fund formation all the way through to exit.
Yeah, thanks so much, David. Let's move on to the main part of this media briefing, right, which is to present the report and the findings. And I'm asking my colleague Andy, who heads data and research for us at DealStreetAsia, to take over from here and take our audience through the key takeaways.
Okay, thank you, Georgie. So good day, everyone. Thanks to our journalist friends for joining us today. I'm Andi Haswidi, the head of research at DealStreetAsia. Through Data Vantage, which is our research and analytics team, we track venture-backed companies, funding trends, valuation, and financial performance across Asia in our data platform. So basically what we are trying to do is to combine the discipline of newsroom reporting with proprietary data, research, and market analysis. So I'll walk you through some of the highlights from our reports. Let me share my screen. Okay. Okay. So our report, Turning Friction into Capital Flow, the Asia Pacific PE VC edition 2026. I'll structure this presentation. Just a second. Okay. I'll structure this presentation around 4 areas. First, I'll briefly explain the methodology, who we surveyed, and what we measured. Second, we'll look at where investor conviction is the strongest across Asia Pacific. Third, we'll compare opportunity with execution challenges and show how different markets fall into different investment archetypes. And finally, we'll look at some of the main sources of friction, and this would cover governance, regulation, exits, and more. So let me start with methodology. So this report is based on our own survey of active private capital fund managers investing in at least one market in Asia Pacific. So we ran the survey in April for 2 weeks, and the findings are based on 105 eligible responses. Of course, we did get more than that, but we screened the responses to make sure that they're the right people that we want. So the respondents came from across private equity, VC. I mean, on the private equity side, this also include those who invest in growth equity, private credit, buyout, and other adjacent strategies. And most importantly, these were not just general investors. So there were people directly involved in investment decisions, including founders, managing partners, managing directors, and all the member of the IC. So our respondent base was anchored in Asia Pacific main private capital hubs. Obviously, Singapore accounted for the largest share, followed by Hong Kong and India. Within Southeast Asia itself, we also heard from fund managers based in Indonesia, Vietnam, Malaysia, and Cambodia. And beyond the region, the sample included respondents from mainland China, Japan, South Korea, and Taiwan. So we also had a smaller number of respondents based outside Asia, and this include US, Canada, and Israel. So, but regardless where they are based, our respondents had one thing in common: they invest in at least one market in Asia Pacific. So let's move on to the survey findings. We'll start with opportunity. So in simple terms, we wanted to understand where investor conviction is the strongest across Asia Pacific. To capture this, we developed the Asia Pacific PE VC Opportunity Index. This is a composite measure of how private capital investors assess market opportunity across the region. So the index itself is measured on a scale of 0 to 1. A higher score means stronger perceived opportunity. So the closer a market is to 1, the more attractive it is seen by respondents. On this measure, India is the clear standout. It ranks first with a score of 0.78. This compares with the Asia Pacific benchmark, as you can see here, at 0.64. So before we discuss the ranking further, let me briefly explain how the index is built. To make this easier to see, I'll move on to the next slide, which breaks down the top 5 opportunity markets across four pillars. So the 4 pillars, starting from the top and moving clockwise, are market growth potential, the operating environment outlook, operational value creation potential, and risk-adjusted return. So each of these pillars is built from multiple questions within the survey. So what stands out in this chart is that, of course, India's lead is broad-based, as respondents rated India strongly across all 4 areas. In simple terms, India is seen as one of the few Asia-Pacific markets where scale, growth, return potential, and hands-on value creation come together. So after India, the next group is Japan, mainland China. And based on these four pillars, both average at 0.72. They are followed closely by Singapore and South Korea. So the top five markets are quite tightly clustered after India. So I'm not going to get into each of the individual questions. You can find them in the report itself on chapter 1. So let me go back to the earlier slide where we can see how when we break down the data by strategy, the picture becomes more nuanced. You can see in this chart, we separate responses from PE and VC. What it shows is that both groups see opportunity across the region, but PE and VC fund managers do not always see it in the same markets. So for PE respondents, while India still ranks first, Vietnam rises to the second place ahead of Singapore and Japan. This suggests that PE managers see more actionable opportunities in Southeast Asia than the headline index alone might suggest. So for VC respondents separately, the picture looks different. While India ranks first, mainland China is a close second. This suggests that venture investors continue to see China as a deep technology and innovation market, even with what is perceived as a relatively more complex macro and regulatory environment and geopolitics, obviously. Now that we have looked at where the investor conviction is the strongest, the next question is how easy is it to actually execute in these markets? This is where we move from opportunity to friction. In other words, we look at practical challenges fund managers face when investing across Asia Pacific. So for the friction index, a higher score means greater execution difficulty. So Singapore has the lowest friction score in the report with 0.32 and followed closely by Hong Kong, New Zealand, and Australia. These markets are seen as easier to navigate because respondents rated them more favorably on areas such as regulatory clarity, governance standards, institutional infrastructure, and predictability of the operating environment. So for fund managers, this means less uncertainty around compliance reporting, portfolio insight, and exit. At the other end, you can see that Cambodia has the highest friction score at 0.66, followed by Indonesia at 0.6, Vietnam, and the Philippines, and so on. But this does not mean that these markets lack opportunity. It simply means that execution burden is higher. So similar to the opportunity index, the friction index is built around multiple pillars. In this case, they are corporate governance, regulatory friction, professional ecosystem, exit environment, and macro risk. Each pillar is based on multiple individual survey questions. So overall, this survey has about 40 questions split between opportunity, frictions, and specific questions for fund managers in regards of their capital formation and much more. We will not go through each questions today in the interest of time, but the detailed breakdown is available in the report, particularly from chapter 3 onwards on frictions, if you want to dig deeper. So now we come to what I see as the centerpiece of the study. This is where we bring the two indices together. So opportunity on one side and friction on the other. So when we plot the opportunity index against friction index, we get these four quadrants where Asia Pacific average serves as the benchmark. So the split is the average itself of the region. So this chart helps us see not only where opportunity is, but also what kind of execution challenge that comes with it. So the first quadrant is what we name as efficient opportunity markets. This is the green one on the quadrant. So these are markets with above benchmark opportunity and relatively low friction. And this includes Singapore, Australia, Japan, South Korea, and India. What this tells us is that investors see both investable depth and more manageable path to execution. These markets combine stronger opportunity with relatively clearer rules, better infrastructure, deeper ecosystem, and more predictable execution condition. The second group is the high conviction markets, which is marked yellow. Mainland China, Malaysia, and Vietnam are here. So these markets offer above benchmark opportunity, but also comes with high friction. So this is why we call it a high conviction. So anyone who invests in sort of like high friction market would have a high conviction. That's the thinking behind this. So mainland China obviously is too big to ignore, especially for fund managers with sector specialization and strong local access. But of course, underwriting remains complicated by regulatory uncertainty and geopolitical overhang. Malaysia and Vietnam also offer meaningful opportunity, but they require managers to be more deliberate around sector selection, governance, operating support, and exit planning. Now, the third group is what we call calibrated deployment markets, which is marked blue. So this quadrant includes Hong Kong, New Zealand, and Taiwan. These markets are comparatively easier to navigate, but the opportunity score sit below the Asia Pacific benchmark, at least at the time of the survey, right? For GPs, this does not mean that deals are scarce. It simply means that opportunity set may be narrower and more selective. And finally, we have the precision entry markets, where we find Thailand, Philippines, and Indonesia. These are markets where capital deployment requires a higher bar. So fund managers need even sharper sector selection, stronger local execution, and deeper due diligence and clearer exit planning from the outset. Indonesia's placement is especially striking because it is, in terms of scale and long-standing appeal as a Southeast Asia's growth market, at least in the last 5 to 10 years. But this result suggests that investors are still factoring in governance as a big concern, regulatory uncertainty, weaker exit visibility, and the recent sentiment headwinds. So the broader message from this quadrant is that the opportunity and friction do not always move together. Some markets offer strong upside with manageable execution. Others still carry conviction but require a much stronger operating playbook. I will stop my presentation right here, and we can continue afterwards in the discussion. So what I have shared today is only a fraction of the full report, obviously, and the report goes further into individual questions that build the friction pillars and what these findings mean for fund managers and also what they mean for CFOs dealing with, fundraising, LP reporting, cross-border structures, and a day-to-day operational complexity. I hope this report offers a useful way to think about the private capital opportunities across the region, not just where investor conviction is the strongest, but also where execution is more challenging. Thank you. I look forward to the discussion.
Yeah, thank you. Thank you so much, Andy. Very insightful, a lot of data points. But Andy, before you go, just one quick question from
Let me just stop my screen for a bit. Yeah.
just one quick question, Andy,
Yeah.
from what you shared. Because one of the big changes in the private capital cycle is that managers are no longer underwriting APAC growth in a cheap money environment. Global rates are a lot higher today. The US dollar has been stronger. The currency volatility has become a big factor in dollar-dominated returns. So, does this report actually capture how risks are showing up in APAC private capital?
Okay. Thanks, Yoji. So I think um, if you look at the report, I mean, you can see more details in chapter 3 where we have dedicated questions, on macroeconomic risk pillar of the friction index. So we don't necessarily like measure the Fed rate, its impact and whatnot, but what it tries to capture is how fund managers perceive the sort of like the transmission of that global rate and currency environment into Asia Pacific private capital returns. And that matters because private capital funds in the region are ultimately judged in dollar terms. So even if a portfolio company performs well operationally, the fund manager still has to think about foreign currency translation, exit timing, valuation pressure, and the path to distributions. So the report touches on this specifically as well, where macro and currency risks are not evenly distributed across the region. Seeing markets like Singapore, Hong Kong, Australia, and New Zealand are seen as lower friction markets from a macro forex perspective, and they may not always offer the highest growth, but they give managers more visibility around currency stability. I guess the more interesting finding is that in higher growth markets like in India, for instance, right? India ranks the highest on our opportunity index, but India also carries elevated macro and currency friction. This is right on the money in terms of what's going on today, right? So you can see uh, the investment case is not simply about growth, it's about whether growth can still translate into attractive risk-adjusted dollar returns. And separately, in Indonesia's case, for example, this is another market where we see, high friction when it comes to macro risk, right? So, in terms of macro and currency friction, Indonesia, sits alongside the broader execution and exit market friction. So the underwriting burden is heavier. So managers need to be more disciplined on entry valuation, I guess, for Indonesia. To me, one of the key message from the report, Asia Pacific remains highly investable, but the return bridge has become more complicated, I guess.
Thanks, Andy. Just one final quick follow-up question. You mentioned India. Across Asia, fundraising has slowed. GPs are finding it tough to raise. Outside India, if you were to list a region or a country, where are the opportunities?
Um, you know, when it comes to opportunities, I guess it's not always about geography, right, JG? Um, I mean, it's really comes down to the focus of your fund. In the earlier part of the cycle, we see, a lot of capital was deployed around broad digital adoption, large addressable markets, and fast user growth. But, today fund managers are looking more closely at sectors where growth is supposed to be, having strong fundamentals, clearer value creation pathways, and more defensible business models. So this, I think, just as a one example, deep tech becomes more interesting these days, at least from my perspective as someone who tracks investment activity in Southeast Asia. In our recent DealStreetAsia deep tech funding, we found that deep tech is taking a larger share of the venture and growth equity funding in Southeast Asia. This is at a time when the market is facing a liquidity crunch, right? So in 2020, deep tech accounted for around 11% of deal volume, but by 2025, that had grown to about 24%. So significant growth. I'm sure Johan can speak on this more in depth. So yeah, even though the broader funding environment remains difficult, this is one of the sectors that the opportunity that I think is becoming more visible in the capital allocation mix.
Yeah. Thanks so much, Andy. I want to come to James and Johan. You bring the practitioner's point of view from the VC. James, let me start with you. You bring the VC perspective, and especially on Southeast Asia. You've described the path to liquidity in Southeast Asia as no long, as longer and narrower. With LP re-up rates under pressure, especially in Southeast Asia, where exits have been very, very tough. How are you managing DPI expectations across 100 plus portfolio companies?
Good morning, Joji, and members of the media. Thank you for the question. So when I described the path to liquidity as longer and narrower, I was speaking to a fundamental structural shift in our ecosystem. The IPO window is incredibly tight as our public markets demand profitability over pure growth. And various other industry analysis have shown that exit values across Asia Pacific have faced consecutive years of compression, with companies staying private for 10 to 12 years or longer instead of the historic 6 to 8 years. So we are operating in a what I call an asset-rich but liquidity-poor market, where converting paper valuations into cash distribution is a very big challenge. So this puts immense pressure on our limited partners. As global re-up rates tighten, our LPs and LPs in general are no longer satisfied with on-paper multiples, and they require hard cash returns measured as DPI, as you mentioned, to justify further allocations. So with more than 100 portfolio companies, we manage DPI expectations by actively engineering alternative liquidity avenues rather than waiting for macro conditions to change, because the macro conditions are forever changing. So first, we are pragmatic about public listings because regional offering platforms remain underdeveloped. Successful tech exits tend to happen outside of Southeast Asia on global exchanges like the NYSE or Nasdaq. And so we are preparing our top tier assets for these much deeper offshore liquidity pools. Secondly, we are leaning heavily into mergers, acquisitions, and secondary sales. So many Southeast Asian unicorns are nearing or have passed their funding exit obligations, and therefore driving an uptick in M&A. So for our later stage portfolio companies, exit options explicitly include trade sales, secondary sale, or share buybacks to return capital to LPs. Relying on a single exit path is a risk that we cannot take. So we manage DPI by manufacturing alternative exits and then building hopefully highly resilient companies, ensuring capital flows back to our investors regardless of the broader market volatility.
James,
Back to you, Georgie.
yeah, James, all of these measures that you mentioned, right? Any anecdotal examples or names that you can provide? And a related question is that, the report's highest friction score, 0.59, is, the multi-jurisdiction fund complexity, especially when it comes to Southeast Asia. Everybody talks about Southeast Asia as one market, but actually it is, several different markets, each with, with its own strengths and weaknesses. And somebody like you, who has been operating in Southeast Asia for many, many years, what operational infrastructure has been most critical in managing your portfolio across different countries?
So thank you, Georgie. So the friction score of 0.59, which I remember correctly, for multi-jurisdiction fund complexity really very accurately reflects the operational reality of scaling a venture capital firm like us in Asia. So when we deploy capital into fragmented markets across Southeast Asia, and as you know, whether Singapore, Malaysia, Vietnam, the Philippines, we have to deal with completely distinct regulatory frameworks and then compliance standards. And so managing this fragmentation internally can really severely paralyze our investment activity or investment speed. So over the years of operation, our most critical operational infrastructure has been our shift towards a centralized, institutionalized fund platform, especially one that LPs can understand, appreciate, and even at times also emphasize that we must have. Specifically, we lean heavily into the Singapore Variable Capital Company Structure, or VCC, framework launched by our Monetary Authority of Singapore. The VCC structure addresses regional friction by offering us pretty much unmatched tax efficiency in Southeast Asia, some flexibility and economies of scale. So to execute this strategy at speed, we partner with world-class fund administration specialists. So our relationship with Vistra has really been a cornerstone of this infrastructure. Vistra provides a full suite of end-to-end solution, handling everything from incorporation, secretarial services to fund administration, cash management, tax compliance, global regulatory reporting. Oh yeah, so quite a lot. And the turning point for efficiency was really utilizing the VCC umbrella structure. And this was with Vistra guidance. So instead of spending months establishing slow standalone funds for every new market opportunity, such as the thematic opportunity that Andy mentioned earlier, the umbrella model allows us to launch agile sub-funds very quickly under a single framework. So with the complex back office and multi-jurisdiction administration handled by a single party, Vistra, our team is entirely focused on just looking for high conviction investment opportunities in the sectors that we're looking for. So managing complexity is not really about avoiding friction. I think the friction will always be there. It is about building a robust operational engine with the right partners so that administrative hurdles don't slow down our capital deployment.
Sure.
Thank you, Georgie.
Yeah, thanks, James. Even for our members, friends from the media, if you have any questions, please drop it into chat. We will take it. Any specific questions, James or David. As in the meanwhile, let me come to Johan. Johan, thanks for waiting. One special mention. We reached out to Johan late last night to join us, and thank you for joining us at such a short notice. I want to ask you more from a PE perspective. We've discussed, or all of our panelists spoke about, how. And the report also talks about how fundraising has been really, really challenging. And within that framework, when we look at mid-market private equity in South Asia, that's even more challenging, right? So, and especially for mid-market managers today, how investable? What are your LPs? What are you telling your LPs? What are LPs asking you in terms of how investable is the ASEAN mid-market opportunities today, and how do you convert that opportunity into realized returns?
Thank you, Georgie, David, Pak Andy, for having me on the call this morning. I guess speaking from my vantage point in Kuala Lumpur, I think that the report validates or confirms what is already happening on the ground. Namely, a lot of the GPs are more constructive on ASEAN than the headline numbers suggest. Malaysia's score, I think, was very encouraging, 0.7 on the PE Opportunity Index, which sits above the APAC benchmark score of 0.64. And I think PEVC funds committed here grew by about 21% to more than 30 billion ringgit in 2025. So I think these are not stories of a market in retreat, but of a market that is in the process of deepening, right? I see a lot of similar stories playing out across the rest of ASEAN too, but perhaps at different paces. And what makes Malaysia stand out, I believe, is the government's conviction to build deeper private markets and the subsequent supporting allocations that have been made by the domestic institutional players such as Khazanah and QAP. I think the reality is that ASEAN still very much is a domestic institution-driven market. Although there is some inflow from foreign LPs coming in, the funds typically are anchored by domestic players. And I think that's a very, very significant difference, I think, that you'll see from many other markets globally that are more developed. In terms of on-the-ground execution, I think what we've seen at Bintang is that across Malaysia, Vietnam, Indonesia, and Philippines, which tend to get lumped together, you have an entire generation of mid-market businesses that are growing quickly but are operating informally. So these companies have typically very fragmented ownership structures, are still dominated by family relationships, tend to have underdeveloped financial controls and reporting, and basically are not yet institutionally ready, right? So I think the GPs that have operational capabilities, that gap represents a very significant opportunity. In that sense, it's less about buying into a macro story and more about buying into the micro story of building a specific business. I think what still makes it hard is the exit story, and this is the big elephant in the room, I think, that we've talked about quite a bit. The report is very clear that exit liquidity in ASEAN remains concentrated and very unevenly distributed. Indonesia and Vietnam, in particular, were singled out. They scored poorly on IPO accessibility and strategic buyer depth. And I think, if you flip the script, this is where there is an exit arbitrage opportunity, especially for businesses that are pan-regional, where GPs who buy into these companies, which operate with an ASEAN footprint, they may be able to IPO their companies in ASEAN jurisdictions where exit liquidity is higher than the core market in which the business operates. So that's a little bit of the perspective, I guess, that we have on the mid-market space.
Got it. Johan, just related to that, and specifically when it comes to Southeast Asia, one of the issues that keeps coming up a lot in the last 1 or 2 years is that, and the report also mentions that governance is not just a compliance issue anymore. I'm not getting into names, but we've had several incidents in Southeast Asia, and I'm sure these incidents happen in all geographies, India, everywhere. But Yeah, the whole governance issue impacts or directly affects LP confidence. It exit the when it comes to exit readiness or even valuations. It has a huge impact. And in your portfolio work, especially with growth stage companies, because you do a lot more of Malaysia. How much of private equity value creation now directly comes from improving governance and institutional readiness?
That's a great question. I think there's a key distinction to be drawn here between the buyout strategies, where I think the governance is a little bit more embedded, versus the growth strategy, where I think governance needs to be a bit more deliberate. And unlike I think the case of buyout strategies where financial engineering takes on a huge slice of the returns thesis, growth investors like Bintang, we live or die by our ability to shape governance improvements. The report is very incisive, I feel, because it cites governance as APAC's sharpest fault line. I think that was the wording that was used, and I couldn't agree more. As someone who is knee-deep investing in mid-sized companies in Malaysia and Singapore, and interestingly, these are probably two of the jurisdictions where governance perceivably should be of lower risk. The risks flagged in the report, which included things like RPTs, weak internal controls, inconsistent financial reporting, these are all baseline issues that I think all growth GPs will need to tackle if operating in this region. The report speaks about the compounding nature of governance friction. I completely agree with this. Governance friction isn't just about compliance, it's about potentially not achieving your desired valuation at exit, and it will ultimately shape LP confidence in your track record if you can't get it right. So at Bintang, we start working on governance diligence long before we get into the term sheet stage. We discuss things like board composition, reporting standards, financial controls, and these are all potentially deal killer issues for us. One reason for this approach is because of the painful lessons we've learned, bitter and hard experiences in the past, but also because as an impact investor, the bar is set a little bit higher. I mean, how can we be confident of a business's ability to produce high quality impact data if they can't even get the basic financial reporting right? Right. So I think one of the more intriguing data points that I found in the survey, it stated that 42% of managers said that governance involvement starts earlier. I found this number perplexing. I thought shouldn't the number be 100%, not 42%? So that's a little bit of my take, I guess, on the governance question.
Yeah, got it. We just, we maybe we can just take two, three questions from the reporters. One of them was not able to send it on chat, so I've just got it on WhatsApp from Yelet ZB. Her question is, which market is the all-rounder that has the best balance between friction and opportunity, and why? So, Andy or David, would you want to go take this? Which market is the all-rounder that has the best balance between friction and opportunity, and why?
I guess the clearest all-rounder would be Singapore. I mean, because the market combines like uh, so I mean the lowest friction index score in the study, but it is not necessarily the largest deployment market in Asia Pacific. But if it offers, in my view, a strong operating environment, deep professional services ecosystem as well. And as you can see in the report, in the survey results, I mean, when it comes to regulatory predictability, capital formation infrastructure, and Singapore is definitely the financial hub for Asia. And if we define all-rounder more broadly, I would also point to Japan, Australia, and South Korea. They all sit in the sort of like fast track market quadrant, meaning that they score above Asia Pacific average on opportunity, and below the friction average. I think India is also in this quadrant, but it is a slightly different case. While it has strong opportunity score in the index, but friction score is closer to the Asia Pacific average. So India is highly attractive, but it requires more execution capability compared to say Singapore or Australia.
Got it. Thanks, Andy. One more question from Jakarta Weekly to you, Andy. You mentioned that Indonesia, Thailand, and Vietnam are in precision entry market category. Could you please elaborate about these countries? Like, what is the most friction that appears for each of these countries? What is the opportunity that fund managers see in these countries, especially Indonesia? And for that, the last part of the question, I would also like James and Johan, to for a quick take on, what are the opportunities that you still see in these countries, especially Indonesia? And
Okay.
you can go first, yeah.
Yeah, yeah, okay. Um, so I guess for Indonesia, I mean, there are three, right? So Indonesia, Philippines, and Thailand in the, what we call as the precision entry markets. So for Indonesia, the biggest friction would be execution risk. And this includes governance, regulatory complexity, as well as, of course, this huge macro risk at the moment. Largely, I mean, there's a global, trend happening, but at the same time, domestically, Indonesia is facing a very, kind of, shall we say, non-traditional fiscal policy, right? And in our index, Indonesia has one of the highest overall friction in the region, just below Cambodia at 0.6. And this also scores high on exit-related friction. But managers still see opportunity because Indonesia has a scale, right? In Southeast Asia, obviously, it's the largest domestic market, rising consumption. That is still true, even though, data now shows that the expansion of the middle class is not as fast, and some say are shrinking. But of course, there's definitely big opportunity in financial inclusion. There's huge healthcare needs, logistics gap, energy transition, and so on. There's a lot of opportunities, but again, friction is probably at the highest. I'm sorry, at least that's my opinion as Indonesia. Coming from domestic challenges that we are having. As for the Philippines, the issue is different. Opportunity is there because again, demographics, consumption, also the BPO with the remittance. And there's a story of this is like Indonesia, like a few years back, where we see digital adoption is getting more traction now, and there's growth in services as well. But these frictions tend to come from the friction side is more on the exit visibility and the market depth and operating complexity. As for Thailand, I guess the opportunity is more selective. It has a more established corporate base, manufacturing links, healthcare, tourism, consumer. So more mature market, but the friction is really, at least according to the respondents, is really about uh, the the sort of like the growth potential and the exit momentum. So it's not as high friction as Indonesia, as Philippines, I would say, but respondents appear to see a not narrower opportunity set. Yeah, I'll
So
end there, Yuji.
James and Johan, thanks so much, Andy. Would love to hear your take also, as fund managers and as those who invest capital into these countries, especially Indonesia currently.
Sure, Joji. Maybe I'll jump in first. I think if you're investing across ASEAN, these are markets that you can't afford to ignore. Indonesia, Thailand, Vietnam, you've got very attractive macro characteristics. You've got very large populations that are very vibrant. They're probably younger than the overall ASEAN average. And of course, they're increasing in wealth as well. Right. So, one of the challenges I think for Bintang is that our mandate is specific to Malaysia and Singapore. So we've had to kind of think quite laterally to solve that opportunity, to capture the opportunities that lie in markets like Indonesia, Thailand, and Vietnam. How do we do this is, we devolve the risk, I think, of operating in these markets to the operator. So we invest in holding companies, parent companies that are based in Malaysia and Singapore. So you get that governance, I guess, halo from both Malaysia and Singaporean jurisdictions. But what you do is you get underlying exposure into markets that are a lot more vibrant, places like Thailand, Indonesia, and Vietnam, right? So we kind of cheat a little bit, I guess. We sidestep that problem that direct GPs would have, but we try not to sacrifice too much of the alpha by not being exposed at all. Right. So I think there are creative ways of getting exposed to these markets without necessarily taking wholesale country risk. when it comes to things like governance risk or regulatory risk or even political risk, right? So I think that's a little bit of Bintang's approach.
James?
Okay. Thank you, Joji, for the question. I think Johan and Andy already covered a lot, so I don't think I can agree anything. I couldn't agree more with them.
Yeah. Dave, let me come to you before we conclude. Maybe one quick question to you. When we talk to GPs, actually more in terms of LPs, the hottest markets, they only talk about two markets in Asia, which is India and Japan. Rest of Asia, China is coming back, but rest of Asia is hardly mentioned. So when in your interactions with GPs and LPs, right? Like how do you sort of what are you hearing? What's the real interest like for Southeast Asia or China or the apart from developed Asia and India, and how do you sort of see the counter or the balance here?
Yeah, it's a good question. I mean, for where we sit, you kind of I would look at the structures that we set up for clients, what GPs are requesting, and kind of where the capital is ultimately flowing, right? The hottest markets from that perspective that we see would be India, Japan, as you mentioned, but I would also add Australia to that list. And then to my point earlier around Singapore, not operating too much in this study as maybe a destination, but more as a hub and a jumping off point, given the strong governance and regulatory frameworks here in Singapore. It provides that hub to jump off and structure into via a VCC structure into Japan or Australia or India. So that's one of the big kind of trends that we've seen over the past couple of years in our business is quite strong right now. The other market that is probably outperforming at least my expectations this year has been China. So similarly, Hong Kong is a jumping off hub into China, has been for the past couple of decades. That still exists somewhat today as far as kind of Hong Kong in the PE VC landscape. But China has performed, at least as I mentioned, outperformed my expectations this year. We're still early in the year, but there does seem to be a bit of a rebound in the PE VC kind of interest for China, both PE and VC. And really, a lot of it is renminbi denominated funds that are being set up there for accessing the opportunities in the China market.
Got it. Yeah. Just one last quick question to James and Johan. The report says that managers are adapting rather than retreating from high friction markets. From your perspective, from where both of you sit, what does that look like? Does it mean very selective deals or smaller checks or bigger stakes, more control, or deeper teams from your end to sort of supervise the companies? What does it mean for you both as fund managers?
Johan, go ahead.
All right, James. I was going to say that if you look at the source of friction, I think the report correctly identifies that the single largest source is probably LP funding. It mentions RIA.
I think Johan is frozen.
He's frozen on mine too.
Yeah.
It's frozen.
Yeah. So James, you can go ahead. We'll try to get him back.
GP strategies. And I think the guys,
Hi.
sorry, could you hear me?
We lost you for a bit.
Yeah.
I beg your pardon. Okay. I'll start again. I mean, I think the reality is that it's very much an LP-driven market. I think the challenge is that a lot of the LP decision-making and thought process around deployment shapes, informs, and influences, I think, what the GPs end up doing as a strategy, right? I think the guys, the GPs who are going to thrive, I think, in this market are quite likely to be the guys who adapt the best to what the LPs are keen to pursue strategy-wise, right? So we're seeing, I think, a lot of LPs, have very strong influences in terms of the types of mandates, the types of specialization in terms of funds, even down to the strategy and the governance of the funds themselves. I think that probably will set the survivors apart from the guys who are really going to struggle in this environment. What, of course, is unspoken, I think, in this part of the world is just how important the relationships are with the LPs. You can be very adaptable, but if you don't have a very strong, relationship angle, I think with the LPs, as adaptable as you are, I think it's going to be very, very difficult for you to make any headway in these market conditions, right? So I think fundraising is the key, and I do believe that the players that will thrive ultimately are the ones that are able to adapt best to what the LPs' preferences are.
Very, very interesting point. James? Yeah.
Georgie, your question was on are we retreating or how are we adjusting to the kind of landscape that we're currently seeing in specifically in Indonesia,
No,
and
no,
that
no.
whether we are.
My question was, what does adaptation actually look like? Does it mean that you will do lesser companies or smaller checks, take larger stakes or more control, or have larger teams to, interact or value creation with your portfolio companies? That's what. So what does it look like on the ground for you?
Well, the situation in Indonesia, as brought up by Andy and then reflected in the report also, has provided a lot of room for reflection on how much of a leeway, how much of a hands-off approach that investors can really take, especially for companies that in recent time have turned out not to be what they claim. So this kind of internal friction and so on can already be adjusted or addressed, as Johan has mentioned, by just being more involved at the beginning and throughout the process as they grow, and not leaving it to chance. And this allows us to also be more accurately provide feedback to our LPs on how the underlying portfolio is performing. Again, rather than leaving it to chance or having nasty surprises at the end of it.
Got it. Yeah.
Georgie.
Thanks. Just one quick point I want to make when we close is that when we ask LPs, especially, right, because Indonesia has had some incidents, but India and China have had far more number of incidents. Why has the impact not been that heavy on these two markets? And some of the points that one point that LPs and even GPs often point out is, these two, especially India, they have reasonably large exit opportunities in the markets. When capital is being returned, when there are capital is being recycled, some of these incidents can be quickly forgotten. Because the companies that are returning capital are returning multiple X. So, LPs are getting their money back. That's just an anecdotal example that I wanted to use. But we have gone nearly 10 minutes ahead of our time. Thank you, everyone, for joining us today. Thank you to all our media friends who joined us. Thank you to David, Andy, James, and Johan for sharing your time and perspectives. And what I hope came through from this discussion is that Asia's private capital market remains a very real opportunity, but it's not like we mentioned earlier, it's no longer one simple growth story. And as James and Johan pointed out, the next phase will be defined by discipline. Where capital is raised, how it is deployed, how governance are built, how exits are planned, and how returns are actually delivered back to investors. And we hope that this report gives anybody who reads it a useful framework to think about these questions. The report is available after the session. Our team will ensure that everybody on this call will get a copy of it if it's not already been shared. And our team, especially our researcher Andy and David from Vistra, will be happy to answer any follow-on questions, or if you want clarity on any data points, or if you have any specific questions to James and Johan, just route it to us. We'll ensure that they're answered. Thank you all for your time, and we look forward to staying in touch. Thank you for joining us.
Thank you very much.
Thank you.
Thank you.
Thank you.